Okay, so if you're getting ready for the SIE exam, you've probably got stocks and bonds down cold. But what about the investments that live outside that traditional box? Today, we're going to dive into two really crucial alternative investments you absolutely have to know: direct participation programs, we'll call them DPPs, and real estate investment trusts, or REITs.
So let's start at the very beginning. When you hear the term alternative investments, what does that actually mean? It sounds kind of broad, I know, but for the exam, you need to have a really specific definition in your head.
And here it is. The easiest way to think about it is this. Alternative investments are pretty much anything that isn't a plain vanilla stock, bond, or mutual fund. The two big keywords to remember here are less liquid, which just means you can't sell them in a hurry, and more complex. And with more complexity, of course, comes a whole different set of risks and rules.
All right, first up to the plate, let's put a spotlight on direct participation programs, or DPPs. The name actually gives you a pretty big clue as to what they're all about. A DPP is basically your ticket to becoming a part owner in a business venture, and these are almost always set up as a limited partnership. The absolute key feature, the reason they exist, is that all the financial results, the profits, the losses, and any tax benefits, flow directly through to the investors. Now, in every one of these limited partnerships, you've got two key players. First, you have the general partner. Think of them as the manager, the one running the show. They make the decisions, and because of that, they have unlimited liability. On the other side, you have the limited partners. These are the investors. They provide the cash, but they're passive. They don't get involved in running the business day to day. Okay, highlighters out for this one. This is a huge point for the SIE exam. A limited partner's liability is capped. It is strictly limited to the amount of money they put in. They cannot lose a penny more. But what's the trade-off for that safety net? Well, they get zero say in management, no control. This distinction is a favorite topic on the exam, so make sure you nail it. So let's just quickly recap the main features of DPPs. They are super illiquid, which makes them a long-term game. This is not for someone who needs their cash back next week. They offer those juicy pass-through tax benefits, but they also tend to come with higher fees and, you guessed it, more risk than your typical stock investment. So, where do you actually find these things in the real world? Well, you'll usually see them in industries that need a ton of upfront cash. Think big-time projects like oil and gas exploration or massive real estate developments. These kinds of ventures are just perfectly suited for that partnership structure. And one last big gotcha for the exam when it comes to DPPs. Yeah, those tax benefits are a huge selling point, but they're not set in stone. Tax laws can and do change. A revision in the tax code could completely alter the financial landscape of the investment. That's a major risk to be aware of. Okay, let's switch gears. Now we're going to put the spotlight on our second alternative investment, the real estate investment trust, or REIT. This is another way to get into real estate, but it's a completely different animal from a DPP. So what is a REIT? Well, it's a company that pools money from a bunch of investors to go out and buy a portfolio of properties that make money. We're talking shopping malls, office buildings, apartment complexes, you name it. It's kind of like being a real estate mogul without having to screen tenants or fix a leaky faucet at 3 a.m. For REITs, if there is one number you burn into your memory, it's this one: 90%. To get their special tax status and avoid being taxed at the corporate level, a REIT must pay out at least 90% of its taxable income to shareholders in the form of dividends. That is a hard and fast rule, and you can bet you'll see it on the SIE exam. Now, it's also good to know that REITs come in a few different flavors. The most common are equity REITs. These are the ones that actually own and manage the physical properties. Then you have mortgage REITs, which don't own buildings, but instead they invest in mortgages and real estate debt. And of course, you've got hybrid REITs, which do a little bit of both. REITs have their own unique set of risks too. Because they often borrow money to buy properties, they can be really sensitive to changes in interest rates. And it's no surprise that their success is tied directly to the health of the real estate market and the economy as a whole. If the market sneezes, REITs can catch a cold. And here is a final and incredibly important exam alert for REITs. This trips a lot of people up. The dividends you get from a REIT are usually taxed as ordinary income. That means they're taxed at your personal income tax rate, not at that lower, more favorable, qualified dividend rate that you get from most common stocks. That is a critical tax difference to remember. All right, we've looked at both DPPs and REITs individually. Now for the main event. Let's put them side by side. This head-to-head comparison is really going to cement the key differences in your mind.
This table really breaks it all down. Look at the structure. A DPP is a partnership. A REIT is a company, a trust. What about liquidity? This is a big one. DPPs are illiquid, hard to sell. But many REITs trade on the stock market, so they're very liquid. And for taxes, DPPs have that pass-through taxation, while REIT dividends are taxed as ordinary income. The simplest way to frame it is this. DPPs give you direct participation in a business, while REITs give you liquid access to real estate.
Phew, that was a lot of info. So let's boil it all down to the absolute must-know points for your exam. Think of this as your last-minute cram session, your final cheat sheet.
First up, DPPs. The three magic words are illiquid, partnership, and pass-through. Remember, all the income and losses flow directly to the partners.
And for REITs, think liquid real estate. They're your way to invest in income-producing properties, but you can buy and sell your shares just like a regular stock. And here's the most important point of all. At the end of the day, both DPPs and REITs are alternative investments. And what does that mean? It means they aren't for everybody. They require a really careful suitability analysis to make sure they're a good fit for an investor's goals and how much risk they're willing to take. So we'll leave you with this final thought to chew on. Now that you can tell a DPP from a REIT, put on your financial advisor hat for a second. Which type of investor would be better suited for each one? Answering that question for yourself is the key to really mastering suitability for the SIE exam.